Wall Street, central banks, and retail investors have one thing in common: their growing interest in cryptocurrencies. According to CoinShares, inflows into crypto funds and products hit a record $4.5 billion in the first quarter of this year.
There's $140 trillion of U.S. wealth, $400 trillion of global wealth. So we're now up to half a percent of global wealth is in crypto. And that's growing. I think it'll be 1% by the end of the year.
Bitcoin gets the most attention among its crypto peers, but critics of digital currencies raise concerns about their structure and their volatility.
Bitcoin is not having any income, doesn't have any users, doesn't have liquidity services, doesn't have a utility. What's the intrinsic value of it? It's just a self-fulfilling bubble.
Beyond Bitcoin, it's the underlying technology of blockchain that is attracting investor interest. According to CB Insights, startups focusing on blockchain raised about $2.5 billion in just the first quarter of this year, outpacing the amount raised in all of 2020. Central banks are also feeling the pressure to create their own central bank digital currencies. A recent survey by the Bank for International Settlements found that 86% of central banks are currently engaged, up from 65% in 2017. The motivation for central banks has been partly to guard against the risk of financial exclusion or digital dollarization if payments shift to privately controlled alternatives.
I do wonder whether, at this point, Bitcoin should also be thought in part as a Chinese financial weapon against the U.S., where it threatens fiat money, but it especially threatens the U.S. dollar.
But how does Europe feel about cryptocurrencies? Digitization is now being felt in all areas of our lives and has already changed the way we pay. A digital euro would be a symbol of progress in Europe and European integration. It will be issued as money in electronic form by the Eurosystem of the ECB and the national central banks of the euro area, and could be used by individuals and companies alike. It would not replace cash, but complement it. Digital euro. Who knows what the future of banking will look like? One person who might know is Ravi Menon, who until 2011 was permanent secretary in the Ministry of Trade and Industry and now heads the central bank of a country that is considered one of the smartest and most advanced financial centers in the world, Singapore.
Menon, thank you so much for your time today.
Thank you, Linda.
Ravi, I want to touch on digital currencies. Not too long ago, central bankers would stay clear of digital currencies, but the landscape has changed. I mean, we have the likes of Sweden, the Bahamas, China, talking about potentially having their own digital currency in circulation. What's your view on whether central banks should be involved in digital currencies?
We should be involved, meaning we need to keep abreast of the technology. We need to get our hands dirty in actually working with the cryptocurrencies, and we've gained valuable experience from Project Ubin, Jasper, because we issue the Singapore dollar as a digital currency in the blockchain. So I think it's important for us to be immersed in it and not stay away from it.
Jasper Ubin was a joint project between the Canadian blockchain network Corda and the Corium network in Singapore. From a collaboration between the Monetary Authority of Singapore and the Central Bank of Canada, it was explored in 2016 whether there could be simpler and more efficient payment and settlement systems through the issuance of digital tokens with the help of central banks. In the first phase, a digital token equivalent of the Singapore dollar was issued. This was based on the proof-of-concept-based Ethereum blockchain. The Canadian digital dollar, referred to as a CAD coin, was developed to understand how blockchains could be used in real-world payment processing scenarios. Phase 2 represented the launch of software prototypes for interbank payments. Mainly, Microsoft was tasked with deploying these prototypes on their Azure blockchain. The final phase explored ways to integrate the platform and digital assets while maintaining the privacy of market participants. Jasper Ubin was a resounding success. It has enabled the Bank of Canada and the Monetary Authority of Singapore to develop a faster and more cost-effective cross-border payment system on a trial basis.
Then the question becomes a bit more, the answers become more nuanced. For what purpose? what is the digital currency supposed to do? So we make a normal distinction between a wholesale digital currency and a retail digital currency. The wholesale digital currency is what you see in blockchains, where, as with any digital token, it does not necessarily have a life of its own, but it's used to effect the transaction. And so Singapore would issue a digital currency, Canada would issue a digital currency to effect cross-border payments. But it doesn't get outside of the banking system. What people hold on to are still traditional fiat currencies. So if the problem you're trying to solve is cross-border payments, you don't need a retail digital currency. A wholesale digital currency would work just as well. So our leaning is that for now, we don't see a compelling need for retail digital currencies, which means central banks issue digital currencies directly to the public.
So, a digital euro would offer the efficiency of modern means of payment and at the same time be secure central bank money? It will lend itself to areas where people are reluctant to pay with cash. The protection of privacy should be a high priority for the euro. In this way, it can help maintain trust in today's payment transactions. It could support the European economy's transition to digitalization and actively promote innovation in retail payments. Currently, the ECB and the national central banks of the euro area are examining what the benefits and risk of a digital euro will be. After all, the rise of assets like Bitcoin is bigger than the South Sea bubble of the time or the Dutch tulip bubble.
Well, you know, our approach with respect to this kind of assets, this is not a cryptocurrency. This is not a currency. This is a crypto asset. It's very clear. This is you know, an asset with very weak fundamentals that is going to be subject to a lot of volatility. I think that whenever you try to find out what are, you know, the kind of characteristics of the asset that you're investing in, you know, you run into difficulties. And that's why, you know, this is, you know, I think that, you know, the point that, you know, the return of these kind of cryptocurrencies, crypto assets is not related to the return of other assets. And that's why, you know, investors have to diversify and to have, you know, a portion of their investments, you know, invested in this kind of crypto assets. I think that it doesn't make much sense in my view. And, you know, that's why, you know, you are going to be subject to volatility. You know, I think that, you know, the situation some months ago when, you know, the prices were rocketing, it's not very different to the one that we have now when prices are moving down. So when you have difficulties to find out what are the real fundamentals of you know, an investment, then I think that you know, what you are doing is not you know, a real investment. What you're doing is a different.
So wouldn't a digital euro count as a crypto asset? Crypto assets are fundamentally different from central bank money. Their prices are often subject to large fluctuations, making them difficult to use as a constant means of payment. In addition, there is usually no trustworthy institution behind them. Payments are in a state of flux, and central banks have an important role to play. The basis of the European payment traffic must be a competitive and innovative payment market that meets the needs of consumers and preserves Europe's sovereignty. Experts from the ECB and the national central banks of the euro area have defined a number of basic requirements for a digital euro. For example, it must be easily accessible, robust, secure, and efficient. So there are a lot of points to consider when launching a digital currency. So says the former CFO of Goldman Sachs, Martin Chavez.
I still don't know what form exactly central bank digital currencies will take. It's not 100% clear at all that they need to be on a blockchain. They certainly need to be highly distributed, privacy protecting, and fault tolerant. There's a geopolitical overlay. So we've seen some sovereigns, such as China, very aggressively introducing a digital currency. And you know, I'm not privy to their conversations, but sure, I would love to have international trade priced in that currency as opposed to dollars. On the other hand, everybody's going to be really skeptical that maybe the surveillance of another state or sovereign attaches to someone's use of their digital currency. And so privacy protection while achieving anti-money laundering and know your client, these are all very, very difficult balances. But I'll go back to something I said 10 years ago when I was talking to one of the early Bitcoin CEOs, and I think it's related to where you started the conversation. I said 10 years ago, I am highly confident that the Fed will continue the digitization of the US dollar, and one day it will be a digitally native asset, effectively a cryptocurrency. And he said that will never happen. And I said, well, I don't use never, and I'm sure it will happen. And there's this divide, East Coast, West Coast, this sort of a little bit of thinking in Silicon Valley that those people in New York and DC will never figure it out. They will figure it out. You can see the foreshadowing of that. I know you were watching closely during the congressional deliberations in the depths of the pandemic, and you might have remembered one version, a House version of the early stimulus bill, directed the Federal Reserve to create a digital US dollar and distribute them to Americans. And I remember thinking, that's a really great idea. Maybe I'll just sit down and code that up over the weekend. Right? The point is that is a huge, huge, huge project. And there's an opportunity both for wholesale and retail to continue modernizing the payment system. We've been electronified and digitized for a long time. Your bank account is an entirely digital construct. The question is, do we want it to be account-based? Do we want it to be like the paper dollar bills we have, except it's a digital token? These are all topics that are very actively being debated right now. I remember when the Argentine peso was pegged to the dollar, and it was great. You could choose at the ATM, and it depended on a currency board doing what they said they were going to do to keep that one for one. And that's the challenge with all of these stable coins. And so I think there is a necessity, absolutely, for there really to be a digital dollar, meaning it is a claim on the United States of America and simultaneously on the Federal Reserve, not something that's close to that. I think it is inevitable that we will get there. And I would not dismiss the power of the sovereign, right? Go back and read your political science, right? The Leviathan, the sovereign can demand that you pay your taxes in the currency that it issues. And that's what breaks the circularity of fiat currency. What if international trade could all be priced in yuan and everything exchanged frictionless in exchange for digital yuan? Maybe I would open up the capital account. Oh, well, then will people actually hold the digital yuan? Well, I'd have to get them really comfortable on privacy, and it can't just be trust us. It would have to be mathematically, cryptographically guaranteed privacy. And so you can be absolutely sure that these conversations are happening.
Marvin Chavez raises an important point here. What about the acceptance of a digital euro? Concerns have been raised that central banks could come into possession of sensitive information about users by introducing their own digital currency. With privately issued payment instruments such as stablecoins, the risk of coming into possession of sensitive information is very high. Most users and investors are also concerned that emerging private payment solutions, especially if unregulated, could introduce cyber risks. In the case of a digital euro, such risks could be mitigated by central bank involvement. A global opinion survey on public trust in monetary institutions, payment features, and digital currencies shows the importance of trust in the underlying systems. While around 79% of all payments in the euro area are still cash transactions, the share of these transactions fell from 41% to 32% between 2017 and 2019 in the Netherlands alone. Young Europeans in particular make extensive use of cash, according to recent ECB surveys, but prefer electronic payments and expect the corresponding infrastructure to guarantee security and speed. The COVID-19 crisis also led to a shift in payment habits towards contactless payments and e-commerce. This shift towards contactless payments occurred despite the fact that banknotes do not pose a particularly high risk of coronavirus infection compared to other types of surfaces that people come into contact with in their daily lives. During the pandemic, the pace of innovation accelerated, and citizens showed an increasing preference for digital payments. Against this backdrop, the Governing Council established a high-level task force in January 2020 to advance work on digital central bank currencies in the euro area. So would a digital euro be centrally managed by the ECB? Brian Brooks has been part of the banking system for a long time and thinks decentralization is key.
Yeah, look, I mean, what I tried to do in my last job in the government running the banking system was to say we're not fans or enemies of crypto, but we do believe that markets need clarity. And so, I'm not saying that more scrutiny or less scrutiny is a good thing, but having a set of rules would be great. I mean, imagine roads with no speed limits, right? I mean, nobody knows if you should drive fast or slow, and so it's super dangerous. And then you have a speed limit and everybody knows what the rules are and they can then adjust their behavior. We need that in crypto pretty urgently. I think the attraction of crypto is more about decentralization and less about lawlessness. That's, again, part of our reputational challenge. For me, what we're building here is a financial system away from central gatekeepers. That's really what it's all about. We're building the internet. People who think what we're trying to do is build secret magic internet money that can't be surveilled, those guys are probably in the wrong line of work. It's that we're building decentralized financial systems that bankers don't control. That's got to be a positive.
And what about stability? At least if you look at other markets. Stability is often associated with centralization, or at least was a consequence of it. After all, the US had a decentralized economy until it has decided to create a Fed to create some sort of stability. But if we want a system of rules here, such as speed limits, isn't that almost like centralization?
We didn't create the Fed, in the 19-teens because decentralization was bad. We created the Fed because we didn't have a technological ability to allow people to transact directly with each other. And so somebody needed to issue the dollars that could be accepted everywhere. But we now have technology that does that. It's sort of like, the reason that the post office was the way we transacted information in the olden days was because there was no way for somebody in New York to talk to somebody in San Francisco. And then we had email and we didn't need the post office the same way that we used to, right? So technologies sometimes supplant the assumptions on which institutions were built. So where you say stability, Romain, I would say brittleness. Yes, it was stable. It was also super, super controlled, right? It was also incredibly expensive and didn't work all that well. It was merely the best thing we have. Now we have something better.
The ECB is the guardian of the euro. Whether it is banknotes and coins or a euro in digital form is irrelevant. Our task is to preserve the value of our common currency. Regardless of its form, a digital euro should ultimately be protected and regulated by the relevant central bank. An essential part of the Eurosystem's task is to provide citizens with risk-free money for their payments. While cash is still the predominant means of payment, new technologies and increasing consumer demand for immediacy are changing the way European citizens pay. This is reflected in the rapid growth of electronic payments.
It has always been through the banking system. And there was good reason for doing that, because the banks then create, out of the monetary base, create money through their lending activities, through the credit creation process. If central banks were to be directly issuing digital currencies to the general public, what do the central banks do with this money? Central banks are not geared up to be the people who extend credit. That's the job of banks. So we need to think that through, how that will work in practice. And then you have to also ask, why is there a demand for central banks to issue digital currencies, quite apart from the cross-border settings for retail? And I think if there is, and this is probably less of a monetary policy question than a political one, if people feel they need to have a digital equivalent of cash with all the properties of cash, the two most important being anonymity and finality. What do I mean? Anonymity means today if I make an interbank transfer to your account, it's confidential. But if the authorities suspect some wrongdoing, they can actually lift and look into the transaction. And that is how we detect money laundering, tax evasion, and so on. Because there's a digital trail, there's a transaction record. So when we go into digital payments, you lose that absolute anonymity of cash. Because if I gave you a suitcase of cash, there's just no way that can be traced.
So why do we need central bank money? or a digital euro for households and companies at all. In an increasingly interconnected and, above all, digitized world, payment transactions often still lag behind the pace of the economy. Regulations, due diligence, and different IT systems between banks and currency areas can still take days, especially for foreign transfers. This is not only inefficient, but also generates additional costs. Bitcoin or Facebook's currency, Diem, intended to fix exactly this problem. However, this is not without risks for users, as no one can guarantee the stability of the currency, as the high price fluctuations of Bitcoin have made clear. A digital euro as a store of value that is available in unlimited quantities would therefore not be useful either. Advantages would only arise indirectly if, for example, transactions were processed more quickly when buying online and companies had a more direct and transparent overview of account balances and transactions. The repeatedly voiced fear that the ECB wants to take cash away from people is therefore groundless. The digital revolution initiated by the ECB would therefore not initially be noticeable for investors.
That takes us to Libra. We've had Visa, MasterCard pulling out. We've had the G7 sounding a note of caution. Where do you stand on that? Because Facebook says that regulators are delaying regulation, and that is tantamount to putting a lid on innovation.
We welcome the innovation. I think Facebook's proposal has generated tremendous amount of new thinking, which I think is essential for the future. And all that you said earlier on about the interest that central banks are showing in digital currencies have been given a big boost by what Facebook has done. On the face of it, Facebook's proposition is that it wants to make cross-border payments cheaper, faster, and better. And it wants to enhance financial inclusion because it's far easier to have a Facebook account than to have a bank account. And Facebook can play that role. Now, again, on the face of it, I think those are lofty ambitions, and I think they deserve an answer that the central banking community and the banking community needs to work on. It's partly because we've not done too good a job at this that you have proposals like this emerging. Not that the proposal is bad, but what I'm saying is that it is pointing to a real gap, and I have empathy for that, to the whole issue of central bank issued digital currencies. Is it purely for payments? Is it for anonymity? Here, I think the argument is about the dominance of the US dollar and whether that is a healthy thing for global financial stability. Because even when two countries trade or when two people make transactions, there is a dollar leg. It gets converted. Our exchange rates, bilateral exchange rates, are all referenced to the US dollar and then back to the cross rates. So is that a good or a bad thing? Well, that system has served us pretty well so far. Going forward, I think it's not unreasonable, as Mark seems to be alluding, not unreasonable to ask if that is the best way forward, whether we should find a more stable system of global reserve currencies. Again, it's all about, it's got nothing to do with the United States per se, it's all about the way regulators and central banks think, concentration risk. Do we have a concentration risk in the US dollar? And what if something went wrong? So do we want something that is a bit more diversified? I think those are the questions. Libra poses that because of its proposal to peg to a basket of currencies.
Bitcoin or Facebook's Libra have made many of the central banks think twice. Digital central bank currencies on the blockchain, so-called CBDCs, have been an intensively discussed topic since 2018. Many central banks of the world are already discussing their introduction or are planning it concretely. So we will soon have a digital euro. But what does that even mean? After all, behind the digital euro is neither a corporation nor a commercial bank, but the European Central Bank. And the ECB's most important goal is price stability. To put it more simply, a loaf of bread will cost just as much in the future with the digital euro as it does now with the MasterCard. And that is exactly what is no longer so simple, since the emergence and ever-increasing acceptance of cryptocurrencies such as Bitcoin and co-central banks have no control over those means of payment, especially their unpredictable increase or losses in value. The ECB wants to counteract this and instead introduce a stable digital currency as a further development of the classic euro. This would mean that in addition to the current payment options in cash or by card, we could get a third, an electronic euro that we could use via smartphone, but also offline via debit card. Many financial experts believe that this is long overdue because in most Scandinavian countries, it is hardly possible to pay with cash anymore, and the ECB must react to this. The ECB is currently examining the conditions under which the digital central bank money could be safely introduced. In an exclusive interview with Bloomberg, ECB chief Lagarde repeatedly emphasized how important it is to guarantee the security of a digital currency and to strengthen trust in it.
Conviction, because I'm the president of the European Central Bank. There is a governing council that brings together all the national central bank governors as well as members of the executive board. And the decision as to whether or not we will move with the digital euro will be taken by that organ, the governing council. It will so decide. And that will be mid-21. Okay, so in terms of what are the deliverables now, we will soon be releasing the analysis of the 8,000 responses that we got from the consultation process. That will be communicated to the European Parliament, which is one of the key players, as well as the Commission and the Council with which we operate, not to mention the Eurogroup. Then after that, mid-21, the Governing Council, on the basis of that consultation and the preliminary work that we're doing, will decide whether we go ahead with experimenting. And then there will be a second decision, probably a year from, I don't know whether it will be a 6 months first assessment or 1 year assessment, whether we actually are going to roll out. But the whole process, let's be realistic about it, will, in my view, take another 4 years, maybe a little more, but I would hope that we can keep it within 4 years, because it's a technical endeavor as well as a fundamental change, because we need to make sure that we do it right. Well, we owe it to the Europeans. They need to feel safe and secure. They need to know that they are holding central bank backed. I would say it's the equivalent of a digital banknote with the same level of security, the same level of backing as the central bank. So that needs to be really safe and solid. And we need to make sure that we are not going to break any system, but to enhance the system. And I'm saying that on purpose because I know that certain intermediaries that we are using at the moment that are relying on us as well, I mean by that the banks, are a bit concerned about those developments. I don't think they should be concerned, because a central bank is not going to invent itself as a client manager, as a risk assessor for the granting of credit lines. So those intermediaries will continue to coexist and to develop their business and to conduct their activity with cash, which will also continue to be available, as well as digital currency. But in my mind, if you just observe how people have behaved during COVID-19, the way in which they've changed the way they buy, the way they order, the way they get their food, the way they pay, it is moving in a digital dimension, which we should not be afraid of, and which should provide, as I said, safe, solid, and secure payment mechanism to Europeans and others.
So another 4 years of development time? Do we still have this time to introduce a well thought out and technically mature digital euro system? The issuance of a digital euro would be relevant to almost all Eurosystem activities and would have far-reaching implications for society as a whole. At the same time, however, experiments on the practical aspects of a digital euro are needed to examine the strengths and weaknesses of the various options. We have heard that many banks fear for the existence. The introduction of a digital euro could affect the transmission of money policy and have a negative impact on financial stability. Also, in crisis situations, when savers have less confidence in the banking sector as a whole, liquid assets could be shifted very quickly to the digital euro. Thus, if withdrawing digital money becomes easier than withdrawing cash, it could increase the likelihood of severe bank runs and weaken financial stability. These examples highlight the need for careful consideration of the design of the digital euro. In particular, considerations should be given to whether it should be accessible to households and businesses directly or indirectly through banks, whether it should be remunerated, and whether individual users' digital euro holdings should be limited or unlimited. For the moment, we are keeping our options open as to whether and when this should happen. The ECB's task is to safeguard confidence in money. It must ensure that the euro is fit for the digital age. The ECB Commission has described some scenarios that could lead to the Eurosystem to issue a digital euro and also listed requirements that the new form of money should fulfill. Scenario 1: positive impact on innovation and autonomy of the Eurozone. Independence and digitalization of the European economy can benefit from a digital form of central bank money made available to citizens. Issuing a digital euro can be a way to promote the digitalization of the economy and support the development of innovative European solutions in all possible sectors. In such a scenario, the issuance of a digital euro would help preserve European autonomy in retail payments and could be a building block for a European solution for point of sale and online payments. Scenario 2: the role of cash as means of payment decreased significantly. European citizens would thus have difficulty accessing the only means of payment provided by the public sector. Extreme events, such as COVID-19, may accelerate the change in payment habits. Raising maintenance costs of cash infrastructures could further drive the decline in cash availability and acceptance. A similar trend is likely to result from the rapid development of e-commerce. Scenario 3: a form of money other than euro-dominated central bank money or electronic money becomes a credible alternative source of value in the euro area. Private players such as Bitcoin or Libra, which are outside the supervision of European financial authorities, or big tech companies that are not euro-dominated, which achieve global penetration and are used for large payments in the euro area, could weaken monetary policies in the euro area. Their influence would also have unclear implications for cross-border capital mobility, which could ultimately affect financial stability. Under these circumstances, the issuance of a digital euro could support European sovereignty and stability. Scenario 4: the EU decides to proactively support improvements in the total cost and environmental footprint of its money and payment systems. The production of payment instruments and their infrastructure is not always energy efficient. A well-designed digital euro can therefore help reduce the overall cost and environmental footprint of payment systems in the euro area. In this context, the Eurosystem would play a catalytic role and lead by example by incentivizing and putting pressure on payment service providers. The following requirements can be derived from these 4 scenarios. The digital euro should be designed in such a way that any negative effects on monetary policy and financial stability are mitigated. Excessive use of the digital euro as an investment vehicle and the associated risk of large relocations should be avoided. The digital euro should be an efficient way to achieve the economy and environmental goals of the Eurozone compared to the alternatives. But with all the visions and ideas, don't we see the biggest challenge in the technical implementation? How can it be ensured for the end consumer, the supplier, or the entrepreneur that a digital euro is available at all times and accepted everywhere? And what role does the time factor play in this? China is already testing its state-owned digital currency called e-yuan. Apps are already being used to make payments in e-yuan. Even states' benefits are partly paid out in the new digital currency. With the digital yuan, China is reacting to cryptocurrencies such as Bitcoin. However, China's digital currency only partially relies on a blockchain. Traditional clearing methods are also used. Facebook's Libra, or now Diem, was also intended to give users on platforms such as WhatsApp or Instagram the opportunity to use the digital currency for online shopping. However, Facebook met with resistance worldwide, in politics and among central banks. Many saw the project as an attack by the private company on a state monopoly on currency and announced strong regulation of private digital currencies. Brian Brooks, the CEO of Binance, fears that without regulations of our monetary policy, we cannot successfully realize digital currencies.
Well, my personal view is it depends on the utility that we're talking about. So remember, every cryptocurrency represents a different function, right? These are all different networks being built for different things. So, if you're talking about Bitcoin, which fundamentally is an investment asset, it's kind of digital gold, we like to say, it ought to be regulated if it's regulated, like investment assets are regulated. It's not a security, of course, but it's something that people buy and hold for its value retention properties. Versus Ethereum is a network for the remission of payments, right? Or for crowdsourcing of funding. And so if it's like a payment mechanism, you'd expect the banking regulators to talk about that, which is what I did at the OCC. So it all depends on what the underlying activity is. Like activities should be regulated alike. They shouldn't be regulated by asset class category. If this is a payment mechanism, it ought to be regulated like a payment mechanism, et cetera. And I think that's the mind shift that regulators need to achieve here.
Facebook has significantly modified its concept of a digital currency. In order to keep the volatility of its prices low, there will initially be only one so-called stablecoin, which represents $1 at a time and whose price can be controlled dynamically or automatically. Facebook has also changed the name. Libra is now Dinam Dollar. However, an application of approval for the European Union has not yet been received. So why is the EU so hesitant to introduce a digital currency? According to Christian Lagarde, it can only be done through the interaction of the market and regulators.
We have to look at the privacy issues. We have to look at a lot of issues that are in a way beyond the realm of central banks. So we need to collaborate with the other authorities such as ministers of finance, European Commission, parliaments, because in due course it will touch people's life in a very intimate way. And what we've heard from the people is that they want privacy to be protected. But at the same time, we need to make sure that it's not accelerating anti-money laundering or the financing of terrorism. So we have, on each and every aspect, we have to strike the right balance. And so that will take a couple of years. And in a couple of years, when the work has been completed, the Governing Council will have to decide green light, red light, there we go or not. My suspicion is that the Governing Council will be very supportive to explore for the next 2 years. And hopefully will commit the budget to do that because it's not without some cost. But then in 2 years' time, whether it's a let's go and have a digital euro or not, I think will be then decisive. Well, we have we try to understand their thinking, their rational, their expectations, and clearly, I don't talk to markets myself, and I refrain from that because I think this is my duty to stay out of it. But we do have people who are on the markets. I mean, you cannot be a big purchaser without actually having some proximity with how markets operate and what is their thinking, what is their rational, what is their expectations. Expectations in particular are critically important. So we have market surveys that market participants participate in and that we look at. It's not the only component that we look at. We look at all sorts of indicators and survey. We are here riveted and determined by one objective, which is price stability that we have to deliver for Europeans. That is the most important thing. Markets obviously play their part, and we have to be attentive to how they think and what they expect and how they see things. But our objective is price stability.
The finance ministers of the largest Euro states, including Germany, France, Spain, and Italy, have spoken out against a digital quick fix. A digital currency should not be introduced until all the associated risks have also been adequately considered in legislation. In addition, restricting the use of a digital euro risks compromising convertibility to other forms of the euro. Changes in interest rates or markets in which the digital euro is treated as a parallel currency pose a threat to the use of the euro as a means of payment in the economy. That the introduction of a digital currency can indeed have positive effects on the stability of a country is shown by the example of Venezuela. The startup Value is helping the people of Venezuela in their fight against hyperinflation.
I'm Simon Chamorro. I'm the co-founder and CEO of Value, and we're a product that helps Venezuelans living in hyperinflation protect their money from losing value, receive remittances, and pay locally to buy food and medicines. Both businesses and consumers are able to exchange goods and services with each other, paying in cryptocurrency. The vision for us is to increase economic freedom.
Venezuela is known for its political and economic instability. Hyperinflation has caused the bolivar to lose 99.9% of its value in just 2 years. Wealthy Venezuelan families saw their fortunes disappear, and the poor were pushed even further into desperation. Simon Chamorro knows this story all too well.
Growing up in Venezuela, essentially whatever my dad and my mom were able to build during their life was lost. When the economy started to fail, we, for example, had water shortages or like electricity blackouts across the country. Money was starting to get hyperinflated. This is not like a sad story that I'm trying to tell. This is the reality of most Venezuelans. More than 99% of the Venezuelans lost everything they've built because the country failed. All of the Venezuelans' savings of most middle-class people went to zero. I knew I wanted to build something. I had to find my purpose. I always knew I wanted to start a company and to build things, which is the reason why I studied industrial design with the hypothesis that I was going to be able to build things. I didn't pursue that career, but I learned a lot of things that got me into tech. So I found crypto through tech. I felt passionate about the technology, and then when I understood the potential of crypto, I realized that Venezuela is potentially the best place to do this at a massive scale. The reality is, if we deconstruct cryptocurrencies, the most basic thing is that it helps disintermediate, and this may have the possibility to change society as we know it. The main problem Venezuelans are going through right now is hyperinflation. Hyperinflation is just a byproduct of total mismanagement of the country.
Venezuela's descent into an impoverished dictatorship put the devastating effects of hyperinflation on full display for the world to see. Lines for basic needs, extreme shortages of food and medical supplies, civil strife, violence. And the citizens spared were the ones who could move their currency out of Venezuela to other more stable currencies like the US dollar, a luxury mostly saved for the ultra-elite. But Simon's platform Value promises the opportunity for everyday Venezuelans to protect themselves from hyperinflation by way of cryptocurrency. And according to him, the unstable conditions of his country are the perfect breeding ground for such an experiment.
Nobody trusts the currency or the government. People are looking for solutions. In a place where people are trying to survive, the barrier of trying new things is much lower. So digital dollars, stablecoins, cryptocurrencies, people are going to be willing to try it with a little bit of money and then slowly kind of get there. Our main objective right now as a company is to enable merchants to accept digital dollars as a medium of payment, and so people have to use the Bolivar less and less. We're focused on building a product that serves from the richest person with a lot of education and technical literacy, from the lowest income person with very low education and low technical literacy. In a country like Venezuela, where the minimum wage is $1, you have a situation where most people are starting their own little business, selling hot dogs or selling the local food called arepas or whatever they do, but they sell it to their community. And you have these hyper-local communities, so we want to help them accept payments in dollars, in digital dollars, stablecoins, and then onboard users. The more consumers that pay in dollars, the better for the merchants. The more merchants that accept it, the better for the consumer. So far, we've moved millions of dollars. We've helped more about than 150,000 households, 30,000 monthly active users, and it's working. The reality is that economic freedom, it's only directly tackled by the innovation that is cryptocurrencies.
But we can't forget that Venezuela has tried this already. El Petro was a proposed cryptocurrency backed by the country's most abundant resource, oil. While El Petro was widely considered a resounding failure, many experts agree that the experiment was a necessary step in establishing cryptocurrency for the future. And Simon is convinced that its foundations, namely blockchain technology, remain stronger than ever and ready for another, more practical iteration.
Blockchain is really a paradigm shift for the human race. It's one of the most important things that has happened in recent history. What you're starting to see is companies starting to completely build their products on top of this blockchain. It's almost like it's creating its own economy. If there's a way to provide more stability and economic freedom and financial freedom to Venezuelans without crypto, I would rather for that to happen than for me to be successful with a product that doesn't bring value to the people.
Venezuela's hyperinflation shows that a country's monetary policy does not always function according to the international rules of the game. Our expectations that the monetary policy of a central bank can save us at any time should our money get into trouble must therefore be questioned in the future, when even an oil-rich country like Venezuela can get into hyperinflation. One who has been questioning this quantitative easing in money policy for some time is Ravi Menon.
I think that is wrong. And I think it's also wrong for central banks to feed that expectation. Monetary policy provides the basis for sustained non-inflationary economic growth. It provides stability, predictability over the medium term, that the value of money will be stable. And that is the basis for then carrying out economic activities. But it can't be that every slowdown, every risk or threat on the horizon has to be addressed by a loosening of monetary policy. I think fiscal policy has a strong role to play, and that has not been sufficiently addressed, partly because too much of the weight has been placed on monetary policy. So I think we need a better balance between the two. Otherwise, it is exceedingly unfair on the central banking community. Singapore wouldn't need QE because our monetary policy is based on the exchange rate, managing the exchange rate. So we're not subject to the zero lower bound of interest rates. And even there, they're thinking of negative interest rates and QE as supplements. With an exchange rate-centered monetary policy, those considerations don't apply. We can, if necessary, bring the exchange rate path to zero, as we've done before. We've never before had a policy of deliberately depreciating the currency, but we can recenter the exchange rate downwards, which we have done before too. If we think the current rate of the exchange rate is too tight, we can always recenter the band downwards. And with that flexibility, there is actually no constraint. So we have fair amount of policy space on the monetary front without having to think about QE.
So while the ECB is currently still working on a concept for the digital euro, central banks in other countries are usually already one step ahead. In 2018, the top banking institution of the Federal Republic of Germany, the German Bundesbank, also announced that it was actively working on a blockchain-based solution. Headquartered in Frankfurt am Main, the institution manages around 200 billion euros in government reserves and is part of the European system of central banks. According to its own statements, the bank is now intensifying its research in the field of distributing ledger technology and has already named a corresponding partner. Ocean Protocol is to support the Deutsche Bundesbank in its further plans with this technology. Founded in Singapore in 2017, Made in Highland develops innovative apps for the coming data economy and connects data providers and users using blockchain technology. Oceans enable data owners to monetize data while retaining control over their data assets. The Deutsche Bundesbank is therefore launching its own blockchain project. The focus of this collaboration is on a decentralized network that allows users permanent symmetrical access to data. This should, for example, enable real-time updates of statistics while maintaining data sovereignty. According to the Bundesbank, Ocean Protocol was the only company able to offer a technical solution for our project that is already operational. In addition, a platform for the secure storage, transfer, and use of public and private data is to be developed. It remains open whether the Singapore company is also involved in research into a digital euro. But what about German companies? How do they generally feel about the introduction and usability of a digital euro? 78%, that is 3/4 of all companies with 50 or more employees, are in favor of introducing a digital euro. Only 1 in 5 companies, 20%, consider these plans to be unsuccessful. This is the result of a recent survey of 652 companies from all sectors in Germany in 2021. Above all, the possibility that other private digital currencies might otherwise come into use, which could undermine European values, speaks in favor of a digital euro from the companies' point of view. 69% of companies see the need for tokenized securities to enable seamless payments and settlement processes in the capital market. Almost as many, namely 64%, think that it is advantageous to have a digital euro should the importance of cash decline. In this way, citizens would continue to have direct access to the central bank in the digital age. That a digital euro would enable the ECB to implement innovative monetary policy instruments more effectively in times of crises is believed by 60% of respondents. Around 40% would like to increasingly automate payment process and see the need for a programmable euro in industry here. The keyword here is M2M payment, i.e. machine-to-machine payments on the internet. Only 11% believe that a digital euro would have no advantages at all. Alongside the advocates of the digital age, however, there are also skeptics about the introduction of a digital euro. 65%, or around 2/3, see data protection risk here if the central bank were to gain deeper insights into our payment processes. Around 1 in 2 companies also see this as a threat to financial stability. After all, issuing the digital euro could reduce the influence of banks in times of crisis. But only 3% of banks and financial service providers think nothing of the ECB issuing a digital euro. Around 8% of the economy as a whole believe that the economy should develop its own solutions for the payment transactions of the future. 13% say there is nothing to be said against a digital euro. Thus, 35% of the banking and financial business are in favor of the introduction of a digital euro. In the assessment of the tendency, 46% would rather agree to a digital euro and only 9% clearly says no. In any case, the ECB is determined to introduce a digital euro. The so-called e-euro, this is to be issued in parallel to cash, which is expressively not to be abolished. This is the ECB's response to numerous new forms of payment, such as crypto assets like Bitcoin, Diem, or China's e-yuan. ECB President Lagarde expects the e-euro to be in the virtual wallets of Eurozone consumers in as little as 4 years, and then to be in heavy use. China is far ahead in the development of a digital currency, and Sweden's central bank is also working on the digital koruna. What the e-euro will look like in the end is not yet known, not even by the monetary guardians. But this much is already clear. The digital euro will be issued and controlled by the ECB just like cash. Like coins, bills, or book money in checking or saving accounts, it will be created by the ECB and commercial banks. Unlike Bitcoin and other crypto assets, the central bank thus retains control over the currency, which is intended to guarantee the stability and security of the digital euro. The e-euro is to be stored in a kind of virtual wallet and move into the seller's virtual cash registered by means of a simple procedure, for example, through an app or a QR code. This will be possible online via the internet, for example, as well as offline via Bluetooth. In the future, it will be much easier and faster to make a payment than before via SEPA bank transfer. The whole thing will work via a separate account, a direct account with the ECB, so to speak, but still managed by the commercial banks. Thus, the euro is still protected by the ECB, even if private financial institutions get into difficulties due to a crisis. Privacy is also increasingly assured because, unlike major US credit card companies, no personal data is transmitted during the transaction. On July 14th, the Council of the European Central Bank decided to launch the Digital Euro project. A lot of analysis have been done, feedback from citizens as well as experts have been gathered, and a practical trial has been conducted, with encouraging results. All of this has made it possible to launch the Digital Euro project. And who knows, maybe in 4 years we will be shopping with the Digital Euro as naturally as we do with credit card or debit cards. The ECB and the Euro area are well on their way to bringing our financial system into the digital age in a controlled and secure manner. The Digital Euro will be the next step into the future for Europe and its citizens.